GM friends, and welcome to the Metacast Crypto Corner, brought to you by Naavik. I'm your host, Nico Vereecke, or Nico for short, and today I'm joined by Aron Beierschmitt, who's the co-founder and CEO of Crypto Unicorns, and we also have Kiet Fong, who's a researcher and angel investor in gaming. The idea for this episode was to take a deep dive into liquidity and what liquidity means for games. If you're building a Web3 game with an open economy, more specifically, we're going to talk about liquidity pools. What are they? Why are they needed? Why do game devs need to think about them? And what can we learn from the implementations we've seen over the past years? And we're also doing a bit of a double whammy in this episode because we haven't had Aron on yet, but Aron is building one of the coolest games out there. Crypto Unicorns live on Polygon. So yeah, let's get going. Let's start with some intros. Aron, you want to give us like a 2-minute background on you?
Certainly, Nico. I appreciate you guys having me on. I am one of the co-founders at Laguna Games, and we are the creators of Crypto Unicorns, a top game on the Polygon sidechain. I'm excited to be here and deep dive into all things liquidity and corns.
Love it. One quick question. What did you do before founding Laguna Games?
Yeah, so I was at another gaming startup called Beyond Games. We were building Forex strategy mobile MMOs. We built, launched, and live operated Battle Strike Force, which had Sylvester Stallone as the face of it. We live operated that game for about 18 months. Ultimately, almost got acquired by Machine Zone. That fell through in late 2019, and over the course of December, myself and Steven Garcia, my co-founder, worked to kind of put together a seed round and rehire a chunk of the ex-Beyond Games team. And that kind of became the seed for Laguna. And yeah, we kicked things off in January of 2020, right as COVID was taking over. So startups are a pain. Startups are a painful process.
Yes. Otherwise, everyone would do them, so.
Exactly.
Yeah. All right, Kiet, how about you?
So I'm Kiet, and thank you, Aron, for being here today. I'm really excited to have you on because I wrote this paper and I was like, man, I wish I actually got to speak with these founders and actually ask them what they were thinking about. So I'm very glad to have you on today. Big background on me. I was in crypto since 2017, but more on the DeFi side. But prior to that, I was actually in gaming. I built and shipped games on Roblox specifically. And then, fast forward to 2022, where Web3 gaming is a thing, and I get to mix crypto and gaming together. So it was a perfect blend. And now I run basically a news aggregator and daily content for Web2 and Web3 gaming news called The Core Loop. And I also am a contributor to Naavik as a research essayist.
Fantastic. And so the background of this episode is a piece that Kiet wrote for Naavik Pro. Which where we provide some very deep pieces on different topics within blockchain gaming, but also free to play, etc. And that was about liquidity pools. And so he wrote 27-page piece.
Yeah,
and so today we're gonna make your life easy. You don't have to read it because we're gonna provide everything you need in your ears. So kick it off. Curious to have you walk us through, and then have Aron's input as well.
Yeah, absolutely. So, Aron, as a Web2 founder who kind of just dove headfirst into Web3, clearly you weren't afraid to experiment with all of the different DeFi primitives, from the liquidity bootstrapping pool all the way to the staking mechanic. Could you walk me through a little bit about your very first foray into this liquidity pool? What was your research process? Who did you talk to? And things of that nature.
Yeah, absolutely. Honestly, a big part of it was my own experience in the space. So I had been, I like to say, I kind of became a crypto degen over the course of 2017. That was really my entrance into the space. I cobbled together about $15,000. It was about every dollar I had in the world at the time, to make my first major investment in the space, January 3rd of 2018, which basically timed the market top pretty much exactly. So I joke because that was my entrance into the space, was like crashing out 85% over the next 2 quarters in 2018, right? And it was really 2018, 2019 that I started to kind of just, really begin to, I guess, drink the Kool-Aid. Like I became very comfortable with kind of self-custody and, familiar with just connecting my wallet to all these dApps and beginning to experiment and use things like Uniswap and other DEXs and things of that nature. And then you had the COVID crash in 2020. And at that point, I go, all right, I've seen this story before, now's the time, right? So I was able to make a pretty sizable investment in Ethereum at 212. And then obviously DeFi summer happened. So I'd been doing a lot of yield farming, liquidity mining and things of that nature. And so it was really a lot of that experience that I took into the pivot of us from kind of Web 2 and into Web 3. So looking at places to deploy, our public sale of the RBW token, the Copper Launch platform came up pretty quickly, right? Because I'd been following the Balancer team a ton, and I'm a huge fan of a lot of the innovations that they've kind of brought to the space, particularly like non-50-50 weighting of pools and things of that nature, as well as pools of varying assets. And so anyway, when they launched this kind of liquidity bootstrapping mechanism, and I saw other projects kind of taking and leveraging that with success, it became kind of the natural place for us to kick off our public token offering.
Got it. And as you know, actually, I want to take a step back and really quick for the listeners at home, could you share what is Crypto Unicorns?
Yeah. So we're a blockchain-based game on the Polygon network. It's all about 2 primary NFT assets. One is land, which you can piece together into these kind of little mini land empires. And then you take your unicorn NFTs and you put them to work on your land. And so you can plant and harvest berries, which unicorns love. Those berries, as well as other materials, feed into a very deep crafting system in which you can take your unicorns, deploy them into the workshop to craft various commodities and items. All of those are used to either upgrade buildings or create evolutionary or hatching boosters that allow you to boost the potential chance of getting higher stat or better part unicorns as you're doing breeding and evolution and things of that nature. So we started with this MVP launch of our kind of farm sim, and then over the course of the next year, we're basically releasing a series of battle loops on top of the farm sim. And the idea is that you take your high stat unicorns off the farm to go and do and participate and compete in these various battle loops, right? So the first is jousting because they're unicorns, they have horns, it's hilarious. Nice. We're so close to releasing some teaser footage of the Unity build of that game loop, and it really does look incredible. It's kind of moved in a very like kind of Pokemon Arena Street Fighter direction that I think is just going to be a lot of fun to kind of watch and compete. And so the overall system is you tie everything to this core farm sim that represents kind of the engine of the overall game economy. So all the commodities that are being produced, for example, like potions and jousting, which buff or debuff you or your opponent, those are coming out of the crafting and workshop system, right? And so with everything we release, we're driving value back into that kind of core farm sim for players that want to participate in that system.
Got it. And how does the RBW token kind of weave into this whole economy?
Yeah, so one of the major decisions we made early on was to very deeply integrate RBW into the game economy and make it kind of the focal point where a lot of games keep their governance token really outside of their game economy. We made it the center of ours. And to do so, we created the Rainbow Token Marketplace, which is actually an off-chain AMM. So we actually use the same equation that Uniswap v2 and many other DEXs use to this day to determine the price of all of our soft currencies. So the vast majority of soft currencies in the game exist within the RMP and are effectively in their own little two-sided liquidity pool. So not only are we doing all the kind of on-chain liquidity stuff that you would expect, we actually have this real-time 24/7, 365 AMM inside of the game where, for example, you can go in and buy plain berries. And the cool thing is, as the prices go up, we naturally see players who've been producing those commodities sell them back into the marketplace. And there's this entire economy sim at the center of the farm gameplay that's very deep and a lot of fun if you're into that style of game.
Wow, that's super cool. I love how you took something that is natively on chain and incorporated it so deeply into your game's economy. That's very clear that you have a core Web3 ethos and values right there.
Big time.
I then wanted to talk a bit more about the Rainbow token launch there. Like you said, you went with copper, and was there a reason why you set the weight a certain way, or is there any advice or anything you would do differently if you could have gone back and changed the LBP?
I mean, I think in our case, we were very, very lucky in the timing of our copper launch in kind of late February of this year. So prior to kind of the market collapse that we've all experienced. And I mean, we've had the largest and most successful copper launch on Polygon to date. I think we raised more capital than anyone else on Polygon, and even competed with some of the Ethereum mainnet copper launches. Advice for people is I do think it's a smart decision to keep it at 3 days. I've seen some people do 4 or 5. I think you want to keep a amount of constraint on the overall time that you're running the IDO, given the I think if you extend the length of time too much, there's not enough pressure to kind of come in, right? As far as the weights, I don't think we did anything special relative to other projects that have launched on that platform. I think a big part of it was just making sure there was enough excitement and demand in the lead up to that round. I do think me closing the kind of private token sell in the lead up to that round helped the public sell, because we had many investors that I talked to that elected to invest in the public round because it did not have the same lockup conditions, investing conditions of the private token sell. So it was an effort to set it up in the right way, but I think it was really external to the variables within the Copper launch platform.
Got it. And speaking of that, external factors, how important did the whole marketing and corralling the community do for the success of your LBP? Any best practices there for the listeners at home?
Education, I think, is really very important. We have a lot of people within our community who are very new to crypto. Many people who've created their first crypto wallet, to come and play crypto unicorns. And so educating people on the mechanism itself, because it's a little strange in that you start with an imbalanced AMA and you're trying to balance it over the course of the auction. And it attempts to balance it by constantly putting downward price pressure. Or downward pressure on price, unless there is demand. And so, in most of the, I guess one part around the strategy that I think is really important, that is probably the difference between success and failure on Copper launch, is what you set the starting price at. I think some projects set it like astronomically high, and what happens is it falls for a long time before getting picked back up, right? Because it will eventually fall to a price where somebody is willing to purchase it. I think it's much, you want to be much more reasonable in that starting price, such that it's reasonable to start with based on your expectation of demand, the amount of buying pressure that you expect relative to the size of your community and these kind of things. Like, we knew how many people we had in Discord. We knew how many people had held NFT assets and things. So we had this like target set of wallets that were likely to participate in the public sell. And we attempted to set a starting price that felt, again, very reasonable. And so you would see, if you go back and look at our copper launch graph, because you can see all the ones historically. And I think that's a very good thing to research for anyone looking at this as a mechanism, is to see how other auctions performed. And I feel ours was pretty ideal because you saw price kind of dip, and then there was just an inflection point at which people were willing to purchase RBW that spiked it up, and then it's remained relatively stable around that price. Where I think fail cases are where it just falls and falls and falls and falls and never kind of picks up. And that to me is an indicator that you likely set the initial price far too high for the launch. Because that's another piece. And this was a part of the education, is it's really important to understand that early on when it's so imbalanced, the price moves a lot quicker and up and down, right? That's a part of the mechanism. And then as the pool gets closer and closer to being balanced, the price is not going to be as volatile, right? Which is intentional again, because towards the end of the auction, you don't want people moving the price crazy up and down, right? And you want larger buys and sells to have to obviously move the price the same amount as they would have, say, on day one. And again, this is a very complicated design to explain, especially to people who, in some cases, had never used an AMM before. And so again, the best practices there is to make sure the community really understands the mechanism, that this is an auction trying to discover the price of an asset. Like what you set it at the beginning is not, necessarily at all where it will land, right? And so pricing that is very, very, very important at the onset. And then to your question or point earlier around the initial weight of, say, USDC or wrapped ETH or whatever the counter pair is to your native governance token. The only thing you can really do there is if you're putting more USDC at the front and it's less imbalanced, is it just means the price will be slightly less volatile at the start. And I don't know exactly personally where I fall on that. I think you want price to be a bit volatile at the beginning so that it can find the appropriate price and stabilize, if that makes sense.
There's a ton to dig in there, but for the benefit of me and some of the listeners, I feel like I'd like to take a step back because I heard a lot of terms there. I heard Uniswap, I heard AMM, I heard LBP, I heard copper, I heard initial balances.
And
the space, we might, be too going too hard to degen too fast right now. So maybe.
Yep. All right. We'll pull the ripcord. You want me to kind of go through them real quick?
So I'd like you to explain to me what problem is a liquidity pool solving for you, and how is it doing that?
Yeah, I think in the broader market, not just with game projects, but just generally in DeFi, like an automated market maker is a different mechanism for trading one asset with another versus the more traditional order book style that a centralized exchange would have, where normally there's just this order book with a bunch of buy and sell orders, and the exchange is in there matching the bids with the offers and, trying to obviously make money on the spread. And so an automated market maker, which is usually in this space encapsulated in a smart contract, so it is simply a trustless mechanism by which I can take one token and go and grab another token, eliminates the need for an order book. And it means that there is effectively on-demand liquidity for the token that you're looking to purchase. So say I have USDC and I want wrapped ETH. An automated market maker like Uniswap, which is pretty much the most popular one in the world outside of maybe Curve. I go to Uniswap and I say, hey, I have USDC and I want wrapped ETH. And it will quote me a price based on the liquidity that exists in that pool. And if I submit that transaction on chain, I will receive that wrapped ETH. The question is, do we start talking about slippage or do we just ignore that fact? Because that is probably the disadvantage of an AMM relative to an order book, is you're likely going to incur some form of slippage, which it just means that, if you really think about it, I always think about it as like two columns of tokens in a pool, right? And again, they're trying to match each other in value at all times, not necessarily quantity, but value. And if I go in and make a very large trade relative to the amount of liquidity that is in the pool, so say there is $1 million of liquidity in this automated market maker pool for wrapped ETH and USDC, and I come in to make $100,000 trade, right? I'm going to incur some slippage on that because I'm handing the pool 100,000 in USDC, and it is going to try and give me back roughly 100,000 in ETH, but it will ultimately end up being a little less because of the slippage that occurs when you make that trade. So the benefit ultimately is finding the pool, or the goal is always to find the pool with the highest amount of possible liquidity, because that will lower your slippage in doing a trade with an automated market maker. So I think the advantages of an automated market maker is it's automated. You don't have a centralized order book. You can immediately fill an order or complete a buy or a sell in this case. And the disadvantage is going to be slippage.
As a buyer, if you are looking to buy a certain token, the disadvantage is that there's a potential for slippage.
Correct.
Why did you decide to, what were the other options? Why did you have to go for liquidity pool? Or what were what was your thinking then? Or is this just the Web3 purist in you deciding, no, we're doing this all on chain?
I mean, there were a lot of options. We could have set a fixed price for the token and said, we're trying to sell 10 million tokens. We'll sell them at 50 cents a token, just throwing out numbers. And let's see if we can sell 20 million tokens at 50 cents a token, right? There are strategies like Aron did on Solana, where there's like a fixed supply of tokens, but you're not just selling them at a fixed price. You're kind of letting people come in and basically put in USDC. And again, they raised like $100 million that way, not setting kind of a fixed price per token. In our case, it's really hard to know what the price of your asset should be. Like, how do I predict what the demand is going to be? And I don't think there's any mechanism to do that, because you're trying to kind of predict what human behavior is going to be, right? And so the advantage that I saw in Copper Launch and the liquidity bootstrap mechanism is the idea that we could effectively run this auction that would allow people over the course of the 3-day period to just naturally determine what the price of our token is, versus me coming in and saying, oh, I want to sell it at this fixed amount. And Aurora, again, didn't sell it at a fixed price. They kind of did an auction as well. The advantage of the liquidity kind of bootstrap mechanism is at the end of it, we just removed that liquidity, and then we put a portion of that in a brand new liquidity pool within 10 minutes. And suddenly we had a live open market for the token once the Copper launch had kind of concluded. And so that was kind of an advantage, given you're already on Balancer. And it made it very easy for us to have liquidity available for anyone looking to buy or sell the token after the auction's kind of conclusion. So there's a ton of options available. You could use an IGO or an IDO platform and kind of go that route. But again, this is a pretty Web3 native approach to it. And there is certainly some desire to stay as Web3 forward as possible.
You said IGO and IDO. What do those stand for?
IDO stands for Initial DEX Offering. So there are many decentralized exchanges that are offering platforms. SushiSwap's Miso is an example of that, where IGG launched. IGO is like initial game offering. They're all kind of the same thing, but like Binance has a platform that they're pitching now, which is their IGO platform. So there's lots of options available for entrepreneurs. We certainly chose a path that, again, was pretty Web3 native, that we were fully in control of. And a huge shout out to the Copper Launch team. It's a pretty complex thing that you're setting up, and it's a very well-documented and easy to kind of step through experience.
Got it. So I'm going to try and explain what I understood back to you, and then you can correct me when I'm wrong, right? Not if, but when. So a liquidity pool is essentially I can imagine two different pools with two different assets where there's liquidity put in. And when I put in liquidity, so let's say we have US dollars and maybe the rainbow token to make it easy, right? Rainbow token is a token that you use within crypto unicorns, and then US dollars is USDC is like a token that is supposedly pegged to the US dollars, easy to think in value wise. And so you have these two pools that have a certain balance. And so they have an initial balance. And so every time someone wants to either, buy the rainbow token or sell the rainbow token for USDC, they can interact and use the liquidity of that pool. Mm-hmm. And so depending on the amount that people buy and sell, the balance will change, and that will shift the relative price of rainbow token compared to US dollars.
That is correct. At this time, we are not listed on a centralized exchange. When that happens, at that point, it gets interesting because the automated market maker is not using an external pricing oracle. It is simply shifting price based on demand, right? And the amount of buys and sells in that pool. And as the ratio or the quantity of the assets shift based on, if more people are coming in and giving the pool USDC and pulling RBW out, the value of RBW is going up. The quantity of RBW is going down in the pool. The quantity of USDC is going up in the pool. And so it kind of ratios around based on that level of activity. When we have a centralized exchange with an order book, there becomes an arbitrage opportunity where if the automated market maker, the DEX, is moving, up or down relative to the centralized exchange, there's an opportunity to kind of arbitrage that pool back to the market price or the external market price of the assets in the pool.
Okay. And so just to complete my train of thought here, because we also started talking about liquidity bootstrapping pools, and I think this is also important. So, we've just talked about the concept of a liquidity pool. It is a way for people, I see someone with a crypto unicorn profile picture and I'm like, holy shit, I want to play that game. Hey, I need this RBW token. Where do I get this? Okay, there's this liquidity pool where I can, put in some USDC or some wrapped ETH perhaps, and I get some RBW, and then I can start playing the game, using it to play the game. Now, how does this all get started, right? That's, I guess, the next question. And, how do you find that initial balance and price? That's what we talked about earlier, where, you as a founder have to decide, okay, we're going to start a liquidity pool, and we have to decide on how much RBW we put in there, and then how much USDC or whatever other token you put in there. And so, could you, again, now that we have a little bit more context, walk us through how you approached that? What price did you have in mind, and how did it, for example, relate to some of the token sales you've done before, if you did any?
So I guess let's just kind of walk through the mechanism and then the sequence. So when you're setting up a copper launch, which again is built on top of Balancer's liquidity bootstrap pools idea, right? And the idea from Balancer originally was, again, you don't know what the price of an asset is going to be because it is based on demand. So rather than set a fixed price for the token in which you'll either not sell out because you set it too high, or you'll potentially leave capital on the table because you sold it too low and it sells out, why not bootstrap the liquidity over time? And so you start by setting the weights in the pool to be imbalanced. So usually it's 50-50 between the two assets in the pool. And for example, we started with 5% USDC and 95% RBW. And we had a target of roughly, I think, 20 million RBW tokens that we wanted to sell over the course of the auction. And so we ended up putting 40 million in the pool. So 40 million sit over here, and we put, I think, just under $1 million USDC for that 5%. And that gave us this starting price of roughly 60 cents a token. And to your question around, how we set that starting price, it's just kind of a result of the ratios and the weights itself. We didn't set that price. And again, in all our education, we were like, this is not us saying we think the price is going to be 60 cents. It could be $1.20, it could be $2.50, it could be 15 cents, it could be 10 cents. Like, it's really your decision. And And the idea of putting $1 million USDC next to 40 million RBW, it gave us, an idea of how quickly or how volatile the price would be, how quickly the price would move up or down in the first day of trading. And, again, a little bit of this is like sticking a thumb in the wind. You really don't know what's going to happen. But again, the mechanism is I think it's every minute or whatever, it's going to slowly tick the price down in the over the course of the auction. And you can kind of see in the projections, if I think had no one bought, eventually it would have gone down to 2 cents or something over 3 days, right? That's just the mechanism. And then if there's people buying, the price is going to move upward, right? And if any tick occurs in which there's not a buy, it's just going to slowly tick down the price because it's trying to find like, okay, no one wants to buy at this price. Let's try it at this price. Let's try it at this price. Let's try it at this price. Again, ultimately getting to 50-50. And so at the end of the auction, we had 20 million in RBW roughly on one side of the pool, and we had just over 14 million in USDC. And that was kind of the end result of that auction. And then we turned it off. We removed that liquidity and we took a portion of it, I think 10 million in total liquidity, and we created a new pool on Balancer to set up that liquidity, because now we had established a market price for the token. I believe it was at roughly 75 cents at the end of the copper launch. And then I went in and created a new 50-50 wrapped ETH RBW pool on Balancer with a portion of the liquidity that we had in the copper launch platform.
Got it. So to conclude this, your initial liquidity bootstrapping pool was a way to get the RBW token out there. It's like a sort of initial offering, and based on the mechanics of how these work, you based on demand, find a price balance after, I guess, a number of days. It is, right?
Correct. It's 3 days. That is a variable that you can set. Most people thus far that have launched use 3 days, and we did.
Okay. And so after 3 days, you have a price where, it stabilizes, and then you use that price as your starting price. You create a new liquidity pool that people can use to trade RBW on. And then, everyone can start playing your game and buying RBW token because it's on chain.
Yep, because the ultimate goal, to your point, is to create a liquid and open market for people to buy and sell your token. Ideally, for people buying the token to come in and play the game, and for some people selling the token who are either exiting the game or more beneficially sticking around and just using and harvesting some yield.
Fantastic. Got it.
Wow. Thank you, Aron, for giving us a really comprehensive overview there. You explained it very, very cogently, much better than I could have.
I tend to rant, and I'm always like, I don't know. This stuff is in the weeds. It's difficult to initially grasp, but I think once you figure it out, there's a real light bulb moment around it.
Yeah, and the worst thing is the LPP is just the start, right? After that, now the token is in the wild, and you have to worry about token emission schedules, staking, protocol on liquidity.
This is the hard part. Yeah. This is when the hard part starts.
So before we dive into all that hard stuff, I would love for you to kind of share with the audience, what is a token emission schedule, and what does it mean to have a staking mechanic? What does it mean to have a protocol on liquidity?
Yeah. So token emissions are a core part of the token economics of just about every governance token that's ever been listed. And usually it includes some fixed time-based inflation schedule in which, you start with a certain amount of tokens. Like for us, at the end of the copper launch, we had roughly 4% of the circulating supply of RBW out and in the wild. And then we did a 10% community airdrop, 1% community airdrop to bring us to 5% circulating supply. And I think we're now at roughly 7.5% of this circulating supply. And so usually you see a graph, right? It has different bands in it, which represent the unlocks of the various pools, if you want to call them that. So like in our case, the team and the investors, we are locked up all the way through March of next year. And then we start a 2-year linear unlock, which means 1/24 of our tokens will begin to unlock every month, which when they unlock, I consider them to be circulating, where right now they are a locked supply that does not and cannot touch the open market. And then in addition to that, we have our ecosystem fund, which has a certain amount of tokens that unlock into it, which again is in the hands of our DAO. And so the DAO can choose to vote on how to distribute those tokens over time. And so this is all kind of encapsulated in our white paper and should be in anyone's white paper that's kind of launched in the space over the last couple of years. And then to your point, staking and in our case, play and earn are the final two pools. And so with staking, this is actually a key point I glossed over in the copper launch that I do think was advantageous for us, is we actually launched staking the moment the copper launch went live. So if you wanted to, you could begin to stake the RBW that you had purchased to begin to earn yield on that staked RBW. And we had a whole kind of fun leaderboard competition that earned you points based on when you staked over the course of the copper launch. And I do think that was helpful somewhat in helping us have a solid auction on that front. So that's something that I think entrepreneurs should evaluate as they look at options for copper launch. But our staking mechanism rewards our stakers pro rata. A little more complicated than that, but I don't think we need to get in those weeds. But it rewards our stakers pro rata based on their SRBW holdings, which is the representative token when you take your RBW and stake it into our staking contract. And then on the play and earn side, we have rewards that you earn in game, right? And right now, that's predominantly by buying and or by selling profitably into the Rainbow Token Marketplace, that AMM inside of the game, which allows you to earn. And of course, you can get RBW gathering and things of that nature. When the battle loops come online, that's going to be when the play and earn rewards really begin to kick off, because we want to reward RBW based on skill over just being able to spend time and kind of grind and to a certain extent like mash buttons, right? We want to ensure that RBW is being rewarded from a play and earn perspective to players who are the most strategic and skillful in our overall ecosystem.
Got it. And when you say players can earn yield and earn rewards, these rewards are paid in RBW, correct?
That is correct.
And then I saw that you on your staking mechanism, I do want to double click here because I saw you could lock your RBW or your RBW LP token, which stands for Liquidity Provider Token, which is like a receipt that you receive when you provide liquidity into, say, like a balance sheet pool, for example. And I know on crypto unicorns, you could lock it up from 1 to 12 months. Is that correct?
That is correct. Yep. Yeah. So that's a key feature. I'm glad you double clicked on it. When looking at staking systems, and we were putting all this together kind of last year. I didn't think any game company, and I kind of believe this to this day, has really solved this problem. Like, what is the appropriate staking system for a game company? So I chose to actually look at DeFi for ideas, and I think the most successful DeFi project is Curve. It's the largest AMA in the world for stable or sort of stable assets, or at least assets that are designed to be roughly the same price, like staked ETH and ETH. Doesn't always work. But Curve has a very unique mechanism by which you can time lock your curve to earn VE Curve, which entitles you to rewards. And the really unique thing I think that Curve has, the unique feature, is that the longer you are willing to lock it up, the more weight in governance you have and the more ability you have to influence the protocol, which I think makes sense. You want to align with the people who are willing to look and think long term over those who are thinking more short term. So our mechanism is not identical to Curve to VE Curve, but it does have the same. It is the same in the sense that if you are willing to lock your RBW for a year, I'm going to give you 4 SRBW for that one RBW. And if you're only willing to lock for a month, you're getting far less SRBW, right? Thus, the incentive to maximally kind of stake and lock up your RBW, again, helps you maximize your influence over the game, over the protocol and the ecosystem.
What is the, sorry to interrupt, Kiet, what is the purpose of staking? And I'm assuming there's staking and there's liquidity pool token staking. So I'm assuming these are two different things. What is the first, like the purpose of the first type of staking for you, Aron?
Yeah, so single side or just pure RBW staking, the primary purpose of that is governance. So in a lot of cases, governance is just a meme with these projects. We chose to really dive deep on it. And I think the response, really shows that we've gone above and beyond many other projects in the space. And what I mean by response is we have over 60% of the circulating supply of RBW has been staked in governance. On average, 9 months or longer, with 12 months being 75% of the entirety, which is really phenomenal. And then we have over roughly 50% of SRBW holders voting on our snapshot proposals. So if you want to influence the direction of the game and the protocol and how we spend the ecosystem fund and all of that stuff, you need to maximize your SRBW, your staked RBW. So the primary function of staking is to get your seat at the table in our governance system.
And so the reason why there is a system where the longer you lock something up, the more voting power you have, is to avoid that people buy a shit ton of RBW, vote, and then sell it again.
Correct.
And play
I
the
think
system
it's
that way.
Incredibly important to align interests, to shift voting weight to people who are willing to take the risk of locking up over the long term, because I think they are going to be much more long term in their mindset. And I think that alignment is very, very, very important, because you're sitting here with team and investors who, we're looking at 4 to 5 years down the road, right? And we want participants within the ecosystem that, are like, I love this IP. I want to see this expand and grow and evolve over time, and I want to participate in that process. And again, to do so, I think, we really focused on making sure there was long-term alignment between us, the developer, and our player base.
Yeah, makes sense. Could you also talk about, so we just discussed a single-sided staking where you're staking RBW token.
Yep.
Before this, we discussed liquidity pool. In a liquidity pool, there's a pool of 2 assets, or it could be 3 as well. But in your case, it's RBW and then another token. Who provides this liquidity? Could you elaborate a bit on that?
Yeah, so initially we did, when we kind of removed liquidity from the Copper Launch platform, we took a portion. We didn't take all of it. We took a portion. We seeded the initial balancer pool of wrapped ETH and RBW. And then we offered to anyone within our community who was willing to take RBW and wrapped ETH and put it into that pool. When you enter a pool in an automated market maker, you give it the 2 ERC20 tokens, and it hands you back what we call an LP token. It's another ERC20 token, but it represents effectively your pro rata stake of the pool. So if I have, 10% of the liquidity in a pool, I'm going to have 10% of those LP tokens. Anyone holding the LP token, which represents a stake of wrapped ETH and RBW, could give us the token or effectively stake that token. In this case, it is not. It does not give you SRBW. It simply gives you staking yield and rewards. And part of that is an acknowledgement that liquidity providers do take on, man, we haven't even talked about impermanent loss, but you take on a lot of risk when you enter these pools. And the RBW yield on top of that is meant to help mitigate that risk. And so, I haven't checked the numbers in a while, but I think we're at least 90% of the liquidity that currently exists for RBW and wrapped ETH in the balancer pool. So we are the largest LP. We do not stake our token, so we are not claiming RBW rewards back into the treasury via that. We let the players do so. And that's kind of how we set it up, for better or for worse. It's pretty typical to set up things in that fashion where you both reward single side RBW staking as well as the liquidity providers. Because again, you're providing a service by creating a more liquid market for the game token. And there needs to be reward for that service that you're providing as well as the risk that you take as an LP provider.
And I'm assuming it's a pretty good thing that you own 90% of your liquidity pool, because that means that it's relatively safe. Where if all of that is external and people start, getting out of the market, then the value of RBW could go to the zero, and there couldn't be no liquidity for people to trade against.
Yeah, I think protocol-owned liquidity is critical. So it needs to be the crux of, I think, any strategy in the space today. We are very likely going to begin to bootstrap more and more protocol-owned liquidity. I was kind of purposeful in not seeding the pool with as much liquidity as possible early on. I will say that hurt in a bear market, because less liquidity means more price volatility. So, some people taking a really bear look at the space may look at our tokens and say, why is this token down relative to some other game projects? It's usually just because of the amount of liquidity that we had in the pool. But the flip side is we now sit on a very, very large treasury, and we have the opportunity to begin to bootstrap more and more protocol on liquidity. And Nico, you hit the nail on the head with the idea that when we own the liquidity and commit to not removing that liquidity as we have, there is more security from the perspective of players in that they kind of know that liquidity is there to stay. And again, I think we're very focused on growing protocol-owned liquidity over the next 3 to 6 months in tandem with us spinning up our growth plans.
Makes a lot of sense. Could we talk a bit about impermanent loss? Because I think it's important. And Kiet, you did a pretty great job describing it in a few sentences in your piece. So could you go ahead and try and give us a good definition?
Sure. It's much better written, so I'm going to plug my essay here. You just go and jump and read that one paragraph. But essentially, the impermanent loss is the difference between the value in US dollar terms of your two assets if you had held them separately versus putting them together. Like Aron had mentioned, every single time a trade occurs in the pool, the quantity changes between asset A and asset B, in this case, RBW and wrapped ETH. So if, you held $100 worth of RBW and $100 worth of the wrapped ETH separately, and at the price they do what they do, at least your combined value would still be arguably the same. Versus if you had put them into the pool, you may end up with more RBW or more wrapped ETH as the price changes. And that would affect the total USD value of your holdings.
And so, Aron, when you mentioned staking rewards for liquidity providing tokens, that is essentially because let's say that I have a few RBW tokens and I have too many, and I have a bit of wrapped ETH, and I'm like, I might as well try and generate a return on this. I hear all these DeFi degens doing yield farming. I want me a piece of that, so I'm going to do it myself as well. I'm going to put my liquidity into the LP pool, but then I run the risk of these, this impermanent loss, where if there are high fluctuations in the value of the assets, or the relative value between the assets, it could be that at the end I have like a shit ton of RBW tokens, almost no wrapped ether left. And the dollar value of both of my assets together combined at that point is way less than what I initially put in. And so for that reason, Aron, you as a developer and as a network owner or decision maker for now, you have some of your token supply that you use to reward the people that are actually providing liquidity to make up for that impermanent loss and that risk.
Correct. So we do provide a portion of the staking reward allocation towards the LP providers. And yeah, you guys are both right. Like the risk is that the price of the two assets relative to each other moves, right? And it's interesting. It actually plays into why we chose wrapped ETH instead of USDC as the pair with RBW, because we figured, like many assets in the space, ERC20 tokens often track the ups and downs of Ethereum. Now, they're going to usually move down a lot harder than Ethereum and sometimes move up a lot quicker than Ethereum. But yeah, you would absolutely potentially end up in a situation in which you had lower dollar value for your LP tokens than what you started with. But you can enter situations where, and this was a lot of the strategies that I used to, I guess still do run, is trying to also get impermanent loss can also be an impermanent gain. I hate that word because it's really just impermanent until you pull out of the pool, right? But you can create situations where the dollar value went up, or I have always really enjoyed strategies where if I'm long ETH and I just want a higher quantity of ETH from when I entered the pool, from when I exit the pool, from when I entered, like that to me, it becomes an accumulation game, right? Because I'm like ETH to 10K in the next 3 to 5 years. Like that's the vision. So I want to start with 50 ETH and grow that to 150 ETH. I care less about the dollar value of, impermanent loss. A lot of people would say, well, why aren't you just day trading in and out and in and out? And that's never been my style. I've always preferred the more passive strategy of let me provide liquidity and earn fees. That's one thing we haven't talked about is when you provide liquidity, you do earn a pro rata share of the fees in a pool. And so what you really care about as an LP, at least what I really care about in an LP in all of our positions, we do a lot of yield farming on Polygon, trying to I don't have the whale money to really go to ETH and generate a return there, but on Polygon, on Arbitrum, on many of the L2s and L3s that are coming out, the liquidity is low enough that you can be kind of a significant portion of the pool. And if it's an asset that's being traded back and forth a lot, you can generate a decent kind of fee revenue. And so the question around impermanent loss is always, well, what did I generate in fees and how did that make up for or potentially offset the impermanent loss that I incurred over the period of time that I was in the pool?
Got it. And to kind of put a bow on this liquidity pool discussion, because I know it's so riveting for the listeners at home. If you could go back in time and tell yourself an advice or some guidance and tips about launching your own token, what would that be?
We structured the launch such that I really wanted the token to be playable, useful in game as soon as possible after the launch. But I very much came into this year. It's the one downturn that I do believe I called. So I was just getting 2018, 2017, like just PTSD and vibes and like, this isn't looking great. And so we did our copper launch when we did it because we wanted to get the token out in the current environment. And then the plan was to launch the game 30 days after. Well, it took us an extra 30 days, so 60 total to launch the game itself. And having a token that is purely being speculated on because there is no utility, I think is a very dangerous place to be. And so going back, I would not launch a token without immediate use and utility for it. And if you look back, I mean, the prices were going up. I mean, it was great, right? But again, it's unbounded. It's just not grounded in anything that was close to reality, I think, because there was just no immediate use and utility. So it was not really our intention to have that gap. It just happened because game dev is not easy. But again, going back, I would only be launching a token that had immediate utility within the game.
It feels, walking or listening to this, that, in order to navigate the waters of Web3 gaming, you almost need a PhD in finance to understand all of the intricacies, to, go from a balancer pool to, a liquidity bootstrapping pool and all these different mechanisms. But this was a fantastic conversation, Aron, and it's exciting what you're doing. And I really like that you represent a hybrid between people that actually know how to build games and someone that is degen enough to go liquidity farming on Polygon, because that's where there's less liquidity and you can actually make some gains there. So really appreciate you coming on here. Where can people find you if they have any more questions or they want to try out your liquidity pool and that stuff?
Yeah, I'm on Twitter at Beierschmitt, so feel free to give me a follow. I'm usually pretty quiet, but you'll see me like and retweet all kinds of degen articles, and so you can very quickly get a sense for what I'm looking at and what I'm fascinated by. Come to our Discord. We have a phenomenal community that hangs out and has a lot of fun every day. And if you can prove your worth and get into one of the founders of the Starcorn channel, I'm more than happy to kind of chat with people there. So those would be the two places to, I think, find me. Fantastic.
I found that I've spoken to a few people that own unicorns, and they are absolutely in love with them. It's pretty crazy. So you've done a great job in building beautiful NFTs and a great experience around them. Kiet, thank you as well for joining and for writing the piece and inspiring this conversation. This was amazing. I would highly recommend anyone that's interested in this, go read the piece. It's, everything we talked about now, probably a bit more succinct and some extra details and some extra graphs, because I think, graphs and visuals are useful when talking about liquidity pools. Yeah. Anyway, why are we doing a podcast? Anyway, this was fantastic. So Aron and Kiet, thank you very much for joining me and sharing your thoughts and insights. And then listener, hope you enjoyed this as well. Hope you learned something. Hope you realized that it's not too late. This is still in a very emerging field. And, in 2 years, we might not be using automated market makers anymore. There might be a new flavor of the month. And maybe we have order books on-chain order books. Who knows? So this space is evolving. But if you want to stay up to date, then be sure to keep following us, keep listening. We hope that you enjoyed, and we look forward to speaking to you in the next episode. Ciao.